All right, let's dive right in. Medspace, a huge name in clinical research, just dropped its Q4 earnings report, and believe me, the numbers tell a really fascinating story. In this explainer, we're going to decode what these results mean for the company and what it signals for their future. So the first thing you see that just pops right off the page? This number right here, 32%. That's the absolutely massive year-over-year revenue growth Medpace put up for the fourth quarter. It's a huge leap, and it blew past expectations. So how on earth did they do it?
First up, let's look at their Q4 report card. And, spoiler alert, they pretty much aced it. We're going to break down the key numbers behind what was truly a blockbuster performance.
So that 32% growth, what does it actually look like in dollars? Well, it translates to over $708 million in revenue for the quarter. To put that in perspective, in the same quarter last year, they were at $537 million. That is some serious momentum in just 1 year.
Okay, a great quarter is fantastic, but what investors really want to know is, can they keep it up? So now let's look at the numbers that predict future revenue. We're going to see how Medspace is fueling its growth pipeline for the long haul.
The most important forward-looking number here is probably net new business awards. It's basically the value of all the new contracts they've just signed. And in Q4, Medspace locked down almost $737 million in new work. That's a staggering 39% jump from last year. It's a crystal clear sign that demand for what they do is picking up speed. This brings us right to something called the book-to-bill ratio. It sounds a little technical, but it's actually a super simple and powerful idea. It just answers one question. Is the company winning new business faster than it's finishing up old business? If that ratio is above 1, the answer is a big yes, and it means their pipeline for future revenue is getting bigger. And look at this! Medpace came in with a book-to-bill of 1.04. Now, yeah, that's a little bit of a dip from the last quarter, which was really high, but it's a very healthy improvement from this time last year when they were just under 1. This tells us they are consistently adding more work to the pile. So where do all those new business awards go? They feed right into this, the backlog. You can think of this as Medspace's mountain of secured future work. And at the end of the fourth quarter, that mountain stood at over $3 billion. That is just a massive reservoir of projects that are waiting to become revenue. I really love this analogy because it makes a kind of complex idea so easy to get. You can have this huge reservoir, a massive backlog, but it doesn't really matter if you can't get the water out of the tap, right? Well, the conversion rate tells us exactly how efficiently Medspace is turning that $3 billion of signed deals into actual real revenue. And this is where the story gets even more impressive. The company's backlog conversion rate, how fast they're turning those deals into dollars, has accelerated dramatically. It's jumped from about 18% last year to almost 24% now. So they're not just winning more work, they're getting that work done way more efficiently.
So let's recap. We've got a growing pipeline, and they're more efficient than ever. Now, let's go check the financial scoreboard and see how all of that translates to the bottom line.
You can see it plain as day right here. The revenue trend is just this steady upward march, quarter after quarter, hitting that record $708.5 million in Q4. This isn't just a one-time thing. It's the result of really consistent execution. And it's not just about revenue either. Take a look at EBITDA, which is basically a key measure of a company's core profitability. It's following the exact same upward trend, hitting over $160 million in Q4. This is proof that their growth is actually profitable growth. And finally, let's talk net income, the actual profit. After a small dip in the third quarter, it just roared back to a new high of $135 million. I mean, from top-line revenue all the way down to bottom-line profit, the whole financial picture looks incredibly strong. Okay, so we know the numbers are really good, but where is this growth actually coming from? In this next part, we're going to pop the hood and take a look at the customers and the specific research areas that are driving all of Medpace's success. When you look at their customer breakdown, there is one thing that becomes super clear. A massive 71% of Medpace's business is coming from small biopharma companies. These are often the really agile, innovative firms working on cutting-edge stuff, and they've clearly become Medpace's bread and butter. And this didn't just happen by accident. It's absolutely a strategic shift. Just 1 year ago, this group was 65% of the business. The jump to 71% shows a very deliberate and successful focus on grabbing more of this high-growth market. They're deepening their expertise right where it matters most.
Now, if we look at what kind of research they're actually doing, 2 areas completely dominate: oncology and metabolism. Together, they make up nearly 60% of their entire workload. This focus on high-demand fields, especially cancer research, puts them right at the heart of some of modern medicine's biggest challenges.
So, we've looked at the past. Let's turn our attention to the future. What does Medpace itself think is coming for the year ahead? This next part covers their official guidance for 2026.
Looking ahead, the company is forecasting that the growth will continue, but maybe at a more, let's say, normalized pace. After an incredible year with 20% revenue growth, they're now guiding for a still very impressive 9 to 13% growth across the board. This kind of signals a strategic shift from just explosive acceleration to strong, sustainable growth.
So, at the end of the day, what this all shows is a company that is just firing on all cylinders. They're winning new business, they're executing efficiently, and they have a very clear strategic focus. The momentum is undeniable. The real question for 2026 is, can they navigate what is a pretty complex global economy and turn this confident guidance into another year of incredible results? That's what we'll be watching.